All right, given that I do believe dividends are going to play an oversized role in future equity returns, there's three stocks that have jumped out to me recently that I want to share with you as something that look of interest. The first is Apple, the second is IBM, and the third is Intel. So we're going to go through these we're going to look at them because I want to show you why. So first thing, let's look at IBM. All right, now I haven't done any analysis of it. I just talked to a guy who has retired from IBM. I talked to a couple of IBM employees last couple of weeks, and I looked at the PE ratio and I looked at the dividend. I said, ooh, attractive. Now, what we want to see is what the debt is. Can they keep paying this dividend? So we don't know. So first thing we're going to do is we're going to say, look, we got I'm not really used to Schwab, so we got to kind of go down to it's a large cap, 128 billion is a market cap. It's got a dividend yield of 4.57, with a trailing price to earnings ratio of 24, pretty low in this day and age. A forward price to E of only 13. So forward, if they make their earnings as they're forecasting, as the analyst forecast, 13. That is very attractive. So we got a low PE ratio, a smoking high dividend yield. It's a large cap for sure. So I'm keen on that so far. That's pretty good, man. So that's good stuff there. What's the price of IBM? 143. So 100 shares would pay. Well, hold on, let me get my calculator. 100 shares, it costs you 14,300 to invest. Finny. All right. So let's keep looking. Fin again. So let's go to. I want to go to ratios. Finny. Fin. Come here. Let's go to ratios. All right, so this is what I like to do because we want to look at ratios in terms of current ratio cash flow. Hold on a second. You can see the PE ratio is significantly lower than the technology sector. Forecast is significantly lower than the technology sector. Price is, because anything that's ratio on price is always going to be lower because the PE ratio, well, I shouldn't say always lower, but because the price is so much lower relative to earnings, all these numbers are good. Price to sales, price to book. Price to tangible book, most recent quarter. I don't know why they have anything there. That's weird. But price to cash flow, return on equity. Now, I always get nervous about return on equity because that could be big because of taking on lots of debt. So that's fantastic, but let's make sure it's not based on debt. And, of course, dividend yield is high. All right, so let's keep going here. We're going to look at sales growth, earnings. Well, that's weird. So year over year, trailing 12 months. So this is during the Corona stuff. We just got to kind of discount that. So sales growth last year was down 35%. Who knows what's going on there? Is that Corona related? I think you got to kind of think so, but I don't know. Payout. Ooh, this is my concern right there. Look at that. Payout ratio is 111%. Dividend coverage ratio. Now that's payout ratio over the last trailing 12 months. So let's read what. So payout ratio just means how much of their total profits is being used to pay the dividend, and that's a concern. The percentage of the earnings per share, excluding extraordinary cash items paid to common shareholders in the form of cash dividends. So they're paying more than their total profits. That's not good. And I wish we had a 10-year growth rate on so we got a 10-year growth rate of 10%. One second. Just spun off part of their company. I think they spun off like a third of the employees, which is, hate to say it, but anytime a company spins off employees, that's always a boost to the profits, which is weird because the employee labor is by far and away the biggest cost for a corporation. Now that's a short-term boost, I grant you, but I don't know. This is that payout ratio kind of concerns me. Book value per share is $24, and the share price is $140. So basically, what's that? 6. The price to book's about 6. Enterprise value, a tangible book value per share. I'm not sure what that in terms of tangible. I don't know. We got quick ratio, current ratio, so they don't have enough cash to pay their current bills, if this makes sense. So that kind of concerns me there. Long-term debt is $48 billion. Long-term debt to capital is 63. All right, so the long-term debt to equity, so they got a lot of debt, man. That is a concern there for sure. So all that debt concerns me. So let's compare this to Apple now. So let's go back. I tell you, the debt is always a concern. So just from this again, it's the first time I've analyzed that. So that does kind of concern me. All that payout ratio is over 100. Long-term debt, quick and current ratio below 1. That's long-term debt to capital is quite high. So that concerns me. So let's look at Apple. And I think this will give you a better idea of with what we're looking at for cash flow relative to what IBM was. All right, so we're going to go to Apple here. Trading the same price, basically 143. My eye is dry. We got 2.4 trillion in market cap. Now, not much of a yield, only 0.61%, but I tell you, man, a 0.61% is better than nothing. PE ratio forward is 25. Again, that's pretty freaking low, man. That's pretty low. I mean, I know you're not getting much of the yield, but I just tell you, man, you're getting something. Let's see here. Where are we gonna go? We're gonna go to ratios here. Where did I go? That right there, ratios. So let's see what their payout is. The reason payout is so important, by the way, is because if times get dicey and the company has a lot of retained earnings, they can always boost the payout ratio to keep investors from selling, if that makes sense. If you have a lot of debt and your payout ratio is above your total profits, how are you going to keep paying the dividend? You're only going to keep paying the dividend by taking on more debt. And it's just not a good place to be. I mean, that's like paying off your credit card with another credit card with another credit card. Ultimately, you got to have to pay off the debt. And so that's a concern I'd have with IBM. This is the first time I've analyzed the stock. That payout ratio concerns me, and the amount of debt concerns me too, for sure. So I'm not going to buy that after all. Apple, on the other hand, we'll just do a comparison, because if Apple price starts sinking, well, they can buy back their shares, obviously. But part two is they can pay out higher dividends. I assume they have the cash flow to do it. So let's look at the price of sales, 6.8, all right, which is right in line with their sector. The S&P 500 as a whole is only 3. So this is definitely a more growth-oriented stock, because you're paying twice for $1 of sales than what a normal S&P is in Apple. Price to tangible book, oof, yeah, that's pretty high. But look, price to cash flow, return on equity, 127%. That's freaking nuts, man. Woo, netta. I don't know why they don't have price to cash flow here for the S&P 500, but let's keep looking. Price to earnings, we talked about that. Price of sales, price to cash flow, price to earnings ratio over growth. I like price of sales. I like price to book. Yeah, it's still pretty high. I want to show you right here. Well, look at that. Payout ratio is only 16%. Man, that's nice. That is nice. Dividend coverage ratio. I'm not familiar with that. The ratio of income available to common shareholders to pay their dividends. So look at that. So they got well more. They got 600 times, or 600%. Is that same as 600 times cash to pay out the dividend? So if you're buying it for the dividend, they got cash on top of cash. So let's look at their current ratio. Making money, cash flow per share, $5.75. Cash per share. So they got $3.73 cash per share. Tangible book value per share. Yeah, there you go. I don't get the book value per share. 3. Okay, got it. Yes, that's all right. Current ratio looked at right. Ooh, only about 1. That's interesting, man. Long-term debt to capital, total debt to capital, long-term debt to equity. That long-term debt still scares me. Now they got enough money to pay the dividend. They got enough money to pay off their current debt, but not much, man. That's interesting to me. So that would tell me they got cash flow. They got cash, so they're paying dividend. They got 600% more than the current dividend. Return on equity 127. Return on, I mean, you can't argue. Sales per employee 2.36 million. Jeez, man. It's just that debt. They've definitely taken a lot more debt. How much cash they just actually got? They got cash per share, $373, $3.73. I don't know how many shares are outstanding. So let's go out how many shares outstanding. And you could do this. I'm not going to do it, but you could just give yourself an idea how much current cash they have. Shares outstanding, 16 billion shares outstanding. I'm not even sure my calculator is going to be able to go up high enough. Oh, yeah, it doesn't go. Anyway, so 16 billion shares outstanding, and they got $3.73 per share in cash, and they only have, I mean, I don't even know how you figure that out. What's that? 3, 16, 32. $48 billion of cash. $48 billion of cash, man. And then we go back to ratios. $48 billion of cash. How much debt do they have? They got 100 and, oof. Yeah, it's a lot more debt than I would like. I'm surprised with total debt again. Look at that. Yeah. Huh. So they got, but that's capital, not cash. So they got 48 billion in cash, 105 billion in long-term debt. So they're, I mean, capital is not just cash, man. And then the current ratio is just taking the short-term, the short-term assets, and divide that by their short-term debt obligations. That makes sense. Accounts receivable or accounts payable, things of that nature. Yeah, I don't know, man. All right, so let's look at. This is why I just buy the index, because when I start getting here, I see a lot of reasons not to buy. What was the other one? Intel. Let's take a look at Intel. All right, so I'm going to write off both those two. I wouldn't hold them and buy myself. That doesn't mean you shouldn't. I don't have the guts, man. I'm not going to lie. I don't like all that debt. Debt scares the bejeepers out of me. All right, let's go, man. Put on pause. So we're looking at Intel, and let's just go their summary here. There we go. 218 billion. 4 billion shares outstanding. Forward PE 11, and past current PE is 12. Interesting. That's pretty good. 2.58 dividend yield. All right. Intel is not mandating the jabba jabba. Always like that. I don't know about the other companies. So let's take a look at ratios here, shall we? All right. So we got return on equity, good. Dividend yield, I like it. Price to cash flow, pretty good. Well, that looks pretty good there so far. Low PE. All right, we're going to go down to right here, payout ratio. Ooh, 30% is a payout ratio. That's pretty good, man. So they have 332% above what they need to pay out their dividends. So I like that. That's good. So now we're just going to see the debt. Annual dividend yield. I mean, so far so good. Now it's just all, but Apple looks so far so good too. Now again, you got these negative earnings per share growth over 1 year. I just don't know what to attribute that to. It just might be because of the stupid pandemic reaction. All right, cash flow. Ooh, lots of cash flow per share. So they got $6 per share, and they had 4 billion outstanding. So they got 24 billion in cash. Is that the way I'm looking at it? All right. Let's see. Oh, now that's what I'm talking about, man. That's what I'm talking about. They only got 31 billion in long-term debt, and they got what we say 24 billion in cash. So the current ratio is 2, which is fantastic. That is what I'm talking about. 31 billion in total debt. 31 billion, and they got 24 billion in just cash money because they got $6 cash per share. And they got 4 billion shares outstanding. Yeah, I like that a lot better, man. That's for sure. Long-term debt to equity. So they only got $37 in debt to $100 in equity. The problem with equity is that it's just like equity in your home. You can't turn that to cash necessarily. I just like debt to cash. So if they got 31 billion in debt and they got 24 billion in cash, they have that's long-term debt, I grant you. But let's just throw the whole thing here. And because they have a huge current ratio, so that means they don't have a huge amount of short-term debt that's turned over very quickly. Accounts payable. So they got 24 to 31 ratio. And if we take our trusty calculator there, 24 divided by 31, yeah. So they got 77% cash to debt. I like that, to long-term debt. I just tell you, man. Now look, I'm not a stock guru. But I don't like debt. Debt is what makes companies go bankrupt and where you lose your shirt. So let's go back to Apple. Apple had what, 46 billion in cash that we figure out. They got how many shares outstanding? 16 billion outstanding. They have 48 billion in. They have 48 billion in cash. I'm surmising. All right, 48 billion in cash, and their long-term debt was 100, I think. 105. So Apple has 48 billion divided by 105. 45% cash to long-term debt. All right, then we'll look at IBM and let's see what theirs is. All right, so IBM's got how many shares outstanding? 896 million. All right, and then how much cash per share? $8.81 cash per share. So we're just going to round it up to 10 and round up their shares outstanding as a million. All right, just to make this simple for me. So we got a million shares outstanding times 10. That's 10 billion. I mean, a billion shares. How many shares outstanding? It was a billion, right? It can't be a million. It's got to be a billion. Hold on just a second. Let's see. Yeah, billion. Okay, so I got billion shares outstanding. All right. I can't do that. 1 billion times 10. That'd be 10 billion. All right, so they got 10 billion in cash. There you go. Even I can figure that one out in my head. That's why I use my calculator. So people say, you get your math wrong. Me. So they got 10 billion in cash, and they got how much long-term debt? Oh, that's not as bad as I thought. 40 billion and 50 billion. So they got 20% cash to debt. Yeah, I tell you. So I tell you, of the three, Intel's best in my opinion. Now, should you buy it? I don't know. You do you. That does look attractive to me. I'm not going to lie to you, relative to the three that we just looked at. Yeah, like to your thoughts, man. You guys own anything? I mean, I know a bunch of y'all are IBMers. You might have some Intel folks here and some Apple folks. You might know more than I do. At the end of the day, it doesn't matter. It's literally a monkey shooting darts at a stock chart does better than the average highly paid asset manager. That's just a fact, man. There's always going to be someone with luck. But as we sit here today, of these three stocks, Intel looks the best to me. Doesn't mean I'm going to buy it. I'm certainly not recommending it to you. I'm just saying in this low return era going forward, supposedly, dividends going to play a huge role. So keep that in mind. All right. Love to hear your thoughts. We'll see you.